Good afternoon, everyone, and welcome to this two-part webinar series on property and building the correct foundations for property investing. My name is Peter Lacandro, the Managing Partner of Chan and Naylor, Melbourne, and thanks for joining us. Hope that you are all safe and well and remain positive and in getting through the situation with COVID that we currently find ourselves in. It's certainly far from ideal for so many of us, especially those in Victoria. As a small business owner, I'd like to take this opportunity to say thank you for supporting us as a business. As a team of tax professionals, we're here to assist you all. We're learning every single day from all the government announcements that are occurring, both federally and across the various states and territories. And we're really doing our best to relay all this information to you. We'll continue to do this from emails and newsletters and webinars like these ones, along with phone calls and texts that we're receiving from our clients. We are certainly obviously in weird and crazy times, and who knows what 2021 will bring, but hopefully it'll be a hell of a lot better than what we're experiencing today. So let's get stuck into everything for you. Okay, so in Victoria, we currently are in stage 4 lockdowns, as I said. It seems like we've been there for eternity, although we are starting to get some freedoms here in Victoria, a little bit by little. However, our offices currently remain closed as per government directions. All our team members are working from home. Obviously, that means there's no face-to-face meetings. We're currently doing a lot of telephone consultations and Zoom consultations, and we're not sure when all this will change. It'll be up to our Premier. However, like many other businesses out there, we've installed and created and using technology to the best of our ability, obviously for the benefit of us, along with the benefit of our clients. We'll certainly keep you all updated as things change, whether it be with the technology that we use or the office situation with the reopening. Okay, so before we get stuck into this webinar, I must advise that this webinar and the various bits of information that I'm about to share with you is general advice only. It is not being designed for your particular situation or considering your circumstances. When looking at making investment decisions, especially with property, considering the cost of some property thereon, it's really, really important to get the appropriate advice from the experts, looking at your goals, your decisions, and your particular objectives as well. I'm certainly, and so is the team, more than happy to talk with you about your particular situation. Okay. Let's have a look at everything. So it's fantastic to have over 230 clients and prospects register for the two webinars and listen in. So thank you. Hopefully I'll go a long way towards explaining everything to do with property and answer any questions or doubts that you may have. Some of the major discussion points that we'll look at. So today we'll look at why invest in property. What type of property should you invest in? Because obviously there's many different property types out there. What are some of the tax deductions available? And some of the more common ones I'm going to elaborate a little bit further on. Like I said, and we're also going to spend a little bit of time on banks and keeping them honest, especially in this COVID situation. Thank you for those of you that have registered for the upcoming webinar 2. That'll be held on Thursday, the 12th of November. And basically at that webinar, we'll look at things a little bit more detail around structuring and asset protection. We'll have a look at SMSFs, and it's really popular over the last few years to purchase property within an SMSF. So I'll go into a bit more detail in that. We'll actually do a bit of a cash flow analysis, and it's important when you're buying property that you understand what the cash flow, the ins and outs are going to be. We'll have a little bit of a look at property outlook for next year and beyond, and we'll also look at the next steps involved. Please, if anyone has any questions, feel free to use the Q&A tab on your screens, and providing I have time at the end, I'll certainly do my best to answer them all for you. Also, once this webinar is complete, we'll be providing on our website a copy and recording of the webinar, along with all the slides as well. I'll show you towards the end where all that will be located for your future reference, and you can access it accordingly. Okay, let's have a good look at things. So what do you need to be a successful property investor? It's a question that I constantly get asked. There's certainly no crystal balling when it comes to investments, and property is included in that. If we did have a crystal ball, imagine who would have bought the whole street 10 or 20 years back. Many of us, me included. However, there are some successful traits that I commonly see with successful property investors. Let's go through a few of them in a little bit more depth. So the first one is to have a 10 to 20 year plan. It's critical. Capital growth, or is cash flow your objective? Is it residential or commercial property, or perhaps metro versus regional? Is it to use the equity growth to purchase more properties, or is it more to generate passive income so you don't have to work again? Or is it perhaps to use your investment property to look after your children and your loved ones, including yourself in the future? Secondly, to have a clear strategy. Whatever you are chasing as your plan, stick to it. Keep working on it. Very, very important. Every decision that you make should relate back to your planning. The biggest question here, for those of you that are looking at investing in property or that already have, do you actually have a plan? Okay. Thirdly, build a great network of people around you. An accountant or tax agent like us here at Chan and Naylor, real estate agent, perhaps a solicitor and conveyancer, a loan broker that works for you, not for the banks, a handyman perhaps, and the list can go on. A great team will always help you achieve so much more than you individually. Fourthly, research. And again, research. Most just buy because their agent or perhaps their family member or friend told them to do so. What are you looking for though? There's a saying, buy the worst house in the best street. Ask for advice from those that have been there and done that, other successful property investors. Fifth, financing, very, very important. Most people think that when they buy a property, it's just to go to the bank and they'll give you the best possible deal. But I just want to reconfirm, if this is not done properly, it will almost stop you in your tracks, possibly achieving your strategy or your plan. The right broker will always look at your objectives, not just today with the first purchase or the current purchase, but more importantly, they'll look at tomorrow as well and what you're trying to achieve. And finally, patience. Most people are in a hurry to become wealthy. With property investing, it does take time. Be patient, allow it to happen, and don't be in a rush. Most people think that they're going to get rich overnight, and that just doesn't happen very often with property investments. Okay, why do so many people invest in property? What makes them comfortable investing in property? We're going to have a look at a few of these things in a moment. We have many clients who invest in property. It may start with a principal residence that we all purchase, might then purchase an extra investment property. Perhaps we have clients, or we know of clients that have 10 or 20 or even more properties. There's no right or wrong. But when it comes down, what is your strategy and what are your objectives as the investor? Let's have a talk through what are some of the things that make people feel more comfortable with property. Firstly, as history. We all have heard the saying that it's a proven medium to long-term performer. that property will double every 7 to 10 years. Like I said at the beginning, we do not have a crystal ball, but history certainly, property is a proven performer. Many purchase property to hedge or bridge to their retirement. So they basically want to get to retirement as soon as they can, but more importantly, they use property investments to provide a passive income in the future. Lending ability, well, property is probably the most thing that the banks love. They love lending to property or for property purchases. Why? Simply because it provides bank with security. And let's be honest, why wouldn't they want to take the whole title from you and I when maybe we only borrow 50%? The yield available. So when people invest in property, they're comfortable with the yield. Please be aware though that there is different yields for different properties. Yield is basically the rental income that you're going to receive each week or each month. The yields vary for whether it's a commercial or residential property, or even those metro versus regional properties out there. So you should be fully aware of what the yield will be on any potential property. Tax advantages. Negative gearing is the big one. I won't get into that too much depth because I'm going to spend a little bit of time on it later on, but that's a big reason why people invest in property. Direct control. People love the fact that they have control over a property versus perhaps the share market where they don't have any control. Even the old saying that I can drive past my bricks and mortar and have a look, that means a lot to a lot of people. Passive income, as we touched on. So passive income is basically regardless of whether I'm on holidays or whether I get out of bed in the morning or whether it's a Monday or a Sunday. With rental properties, passive income basically means that the rental will continue regardless of what I'm doing or what day of the week it will be. That appeals to so many. It's a chance. Property also provides a chance to build generational wealth. So people love buying properties and ultimately passing that on to their loved ones or their children. It's certainly an attractive reason why many do it. Protection in an economic downturn. You would have all heard the saying, and even the capital growth performer is the next one. You would have all heard the saying around property is less volatile than other investments. And here we are in the middle of a COVID situation that none of us with that crystal ball could even plan for this time last year. However, property is basically will ride the waves. You know, we went through a GFC a few years back now, or 10 years to be honest, and supposedly we're so far better off in that regard. And property's performed or grown further than what it was. And that's where the volatility comes in when compared to the share market, for example. And like I said, we'll have a look at negative gearing a little bit more closer in a moment. Okay. One thing I did want a property tip out there. When investing, I should say, in a property for investment purposes, please take the emotion out. You will not be living there. It doesn't matter what the color of the paint is on the walls, perhaps what the kitchen looks like and you're not comfortable to cook in there, or perhaps the garage is not where you'd ideally like to park your car. It doesn't matter. Like I said, the old saying, buy the worst house in the best street, and you'll find that generally the value will increase. When you're buying a property, things to consider. Are there schools around? Hospitals? Public transport? Shops and access to offices and work sites are just to name a few. But basically take the emotion out. You do not need to live there. Sometimes I have people come to me and say, Peter, what do you think of this property that I'm buying? Or what do you think I should do here? Or what type of property? Generally speaking, I always have a saying called an open window policy. If I buy a 1-bedroom studio apartment generally I'm limiting myself to who would be able to rent that. So the window is generally closed or very slightly ajar for people to be able to rent. Whereas if I bought a 3 or 4 bedroom bricks and mortar with a double garage and a nice kitchen or whatever it might be in the suburbs, generally speaking, I'm opening my window to allow young people, families, older people or retirees. Generally, there is more demand for that rental property. So I call that the open window policy. Keep your window open as much as you practically can. Negative gearing. So as I promised, I think it's important that we touch on negative gearing. It should be viewed as a tax strategy only. What is negative gearing? It's basically where the rental income is less than the rental expenses. So what is rental income? Quite simply, it's the $400 per week or the $1,500 or whatever it would be per month that you're entitled to receive with someone renting your property. What are some of the rental expenses? Well, that would include agents' fees, council rates, water rates, insurances, repairs and maintenance, along with depreciation. So generally speaking, you will make a rental property loss. And when you do that, that will generally offset against your other income. For example, your PAYG earnings. And that works towards saving some taxes. Let's have a look at a bit of a case study to explain a little bit further. So we have Roger. He's a carpenter and he's currently on wages earning about $80,000 per annum. We'll just keep him single in this case for simplicity. He purchases an investment property and he basically is going to, also maybe Peter comes along and rents that property for $400 per week or just under $21,000 per annum. Let's say the expenses, including depreciation, add up to $27,000, and I'll spend a little bit more time later on the different expenses available. But basically that 27 obviously exceeds this 20,800 as the money coming in, and that would represent a taxable loss of 6,200 or a negative gear. Now, when he goes to prepare his tax return, there's two things that we as tax agents would do. We would complete his tax return like normal. So all his income, perhaps a bit of bank interest or dividends that he may have, take away his work-related expenses. Okay, so, and we'd come up with a taxable income. But let's just presume in this case, like I said, his taxable income is $80,000. We would then need to also complete what's referred to as a rental income and expenditure statement. Very important, and it's a must that we do so. So that without that investment property, he has a taxable income of $80,000, including Medicare levy. There's a taxes of $19,147. So his take home per annum would be just under $61,000 or about $1,170 per week. Now, negative gearing, how does it work? He still has his taxable income of $80,000. We as tax agents have completed a rental income and expenditure statement, listing all the income, taking away the expenses, resulting in a tax loss or negative gear of $6,200. That would offset against his PAYG income, and now he has a brand new taxable income adjusted for the property of $73,800. Because it's lower than 80, you can see here the taxes would come in at just on $17,000, including Medicare levy. He would obviously take home less on both an annual and per week basis. So he'd basically be out of pocket $4,000. but that factors in depreciation, which is not really coming out of his pocket. It's really a non-cash flow item on a year-by-year basis. And we'll cover depreciation in a moment as well. Just for completeness purposes, I thought I'd show you the difference. What happens if Roger, in this case, made a profit of $6,200? His income would jump to just over 86 on his tax return. And you can see there the extra taxes that he would be applicable for. So you can basically see how it affects your own personal tax return. This is very general in an overview, because like I say, there's so many more factors to come into account. But it's a perfect way of just explaining how negative gearing would work on your tax return. So in summary, with negative gearing, it is a tax strategy to make a loss only. Tax strategy. Remember one thing though, you're still paying money to the bank. So just because the tax office you might be saving something, you're still paying X amount of dollars to the bank. So really, rental properties or investing should be about building wealth, not making a tax strategy loss when the money is still going out of your pocket to the bank. Couple of questions. What happens if interest rates go up? Can you afford to still make the repayments? What happens if the tenant stops paying? Or perhaps during a COVID situation, they must shut the business down or shift out because they can't afford it. Again, can you continue to repay the bank still? And be very, very careful. A change of legislation by our governments can occur at any time. And the classic example of this was the last federal election that we went through with Mr. Morrison and Mr. Shorten a few years ago. It was Labor's policy that they went to the election at that point to get rid of negative gearing. Many would argue, and especially property investors out there, thank God they didn't win. But what will happen in the future? Again, we don't have that crystal ball. Okay. For more information on negative gearing, we've created a brochure. You can access it via our website at the appropriate link there. So under our website, there's a full brochure, quite a few pages long, which goes into case studies and examples of negative gearing. So if you'd like to have a bit more reading around how negative gearing works, by all means, go ahead and download that fact sheet and yell out if you've got any further questions, obviously. Okay. Enough on negative gearing. What types of property out there and what are the options when we're looking at getting into the market? So obviously the first one is residential. That could be the normal houses that many of us live in. It could be apartments or townhouses, warehouses perhaps that have been converted, or whatever other area that we decide to live in. Commercial. So commercial is commonly factories, offices, warehousing, even shopping strips in certain cases. So some people prefer commercial. The old saying is that commercial will have a higher yield when compared to a residential property. But generally, residential will grow quicker compared to commercial. But again, it depends on locations, the type of property, the state and that we live in, whether it's metro versus regional. The other option is land. So again, we have many clients that buy land. Why? They're banking for future growth. So many people use that as a strategy. It costs them a little bit along the way with rates and possible insurances or whatever, upkeep, but generally they're banking for future growth. And we all know how scarce land is becoming, especially in the metro areas. What are some on-costs when you're buying property? And it's very, very important that you need to understand these and factor in how much you should be spending in relation to buying a property. The first and the most biggest generally is stamp duty. So I know here in Victoria, you can jump on the State Revenue Office website. It's a state tax stamp duty, so it does differ. But certainly here in Victoria, there's a calculator, and it's generally about 5.5% of the purchase price of a property. There's going to be legal fees or conveyancing or settlement fees as well. You probably would have borrowing costs. So that may perhaps be mortgage insurances and loan or bank fees. Structuring becomes very important, and I would always recommend that people speak to their accountant and get some advice of whether it's a good purchase. Sometimes it amazes me that as an accountant, people are looking at spending 5, 6, 700,000, possibly more, yet they're afraid to talk to their accountant and receive a very small bill when compared to the purchase price. Surely you need to surround yourself and at least bounce it off someone else that understands how all that works. And please, please do that. We've seen so many mistakes over the years and some properties that have caused some financial hardships. When you're purchasing a property, is it that run down, or are there any initial repairs or capital improvements that you need to undertake? It's very important as well, because there's no use buying a property for a bargain and then it ends up basically spending or costing you another 50,000 before you can rent it out. There's going to be lease and letting fees from the agent initially, and possibly on an ongoing basis as well. Depreciation reports would be recommended to obtain. And again, I'll go into that and why it's of a benefit in a moment. Many out there also look at pest and building reports or structural reports. Very important again that if you're going to be spending quite a lot of money on a property, you don't want it to have termite infection as well. So very important to consider. Before we get stuck into a lot of that, I thought it'd be good just to quickly touch on our principal residence, because as Australians, many of us have a principal residence, and I thought it'd be good just to double check a couple of things and reconfirm a few things. So generally, our principal residence, when we dispose of it, it's capital gains tax free, simply because it's our principal residence. Be very careful though, that if your principal residence has been both, maybe a principal residence for a period of time and or an investment property for a period of time, it's important to get the tax implications before disposal. That could change the character of your property. Generally, land tax is nil, certainly is here in Victoria. Your mortgage interest that you're paying is generally non-tax deductible. And generally your expenses, so we would have council and water rates, insurances, possibly some repairs or gardening that we need to do, generally they are non-tax deductible. Okay, one property tip, if any of you out there have private debt, perhaps on your principal residence, or those credit cards have taken a belting, versus investment debt, for example, on your rental property, it would, as a tip, get rid of your private debt first. If you can't claim it as a tax deduction, why wouldn't you want to reduce it as quickly as possible? More importantly, and we have many clients that buy that first home that they love and fall in love with, perhaps when they get together as a couple or have a young family, it becomes too small or they decide to upgrade. But they really don't want to sell that little property that they bought some years back. So they decide to change the character of the property and they basically would like to rent it out. So many people across the country do that. Obviously, the character changes and it is now an investment property versus your principal residence. So that's where I said the tax character will change. What do I recommend? When you shift out of it, we may never need this, but I would highly recommend that you get a market valuation done on that property. Get a couple. Doesn't mean that you need to go and spend thousands of dollars to do that. Perhaps at least a few emails or a few written reports from your local real estate agent, just confirming a rough range of the market value of the property. That may come in handy down the track if we've got some tax implications that we need to look at. There'll be possible land tax that will incur or will start happening. That depends on your other ownership of property. Please check that with your state revenue office. And we've seen many occasions where people will shift out of a property. They will not notify the state revenue office, and then they get a nasty shock in the mail some years later with multiple bills over multiple years that they now have to back play, plus interest and penalties of land tax bills. So be very careful and notify the appropriate authorities. And then your mortgages and your interest will basically from that point onwards become tax deductible. Yes, there's many other things that we need to look at, and I'll cover it in a moment, but interest comes around the purpose test, guys, not the security on the property. So we'll talk about that in a little bit more detail in a moment. Okay, let's have a look at the big one, which many of you hopefully are fully aware of, but I thought it'd be worth clarifying a bit further. So generally the purchase of an investment property, it will always be, or certainly could be, one of the biggest decisions that we'll make in our life, both emotionally and financially as well. And generally we find, and from prior experience, the first investment property that we buy is generally the hardest decision as well. So it's imperative that we get it right. So many factors that you must consider, many that we've already gone through, but that would include location, price, finance or borrowing side of things, the structure to purchase it in, the rental property manager that you may use, or perhaps you prefer to do it yourself, and the tax consequences obviously as well. Unless you are an expert in all these areas, again, surround yourself with the best professionals in those respective fields. And generally you as the landlord or the owner of the property, you will generally be assessable on all income tax or assessable on income tax on all the income that you earn. And obviously, as a landlord, you will be able to claim deductions for those losses or those expenses in incurring that income. Let's get into it a bit further. So firstly, again on our website, there are two brochures here, and that's the link, full listing of all tax deductions that may be available to you. So please, we produce these resources and these brochures to give you information, to educate you, to make you aware of what you can possibly claim. This one here, the rental property deductions checklist, that is a general listing of all the types of expenses available. Where this one here, the overview, goes into a few more things in detail, like interest, depreciation, repairs and maintenance versus capital improvements. So it provides a little bit more detail in specific areas. But it's very important that you as the landlord, unless you love paying unnecessary money to the ATO, that you fully and legally minimise your tax liability. And by claiming the right tax deductions will certainly enable you to do that. Be aware, all tax-related deductions, you must keep documents for a minimum of 5 years. obviously the receipts, etc. Because if the ATO have questions, and they are on the prowl, they will basically want to cite those receipts and expenses. Okay, very, very important. Let's have a look at a few of them though in a bit more detail. And the first one that I wanted to cover was bank interest. Many people out there basically have to use the banks to purchase, whether it's to purchase their investments. Now, the one thing which is very, very important, the deductibility of any interest on your tax return, it's determined by the use of the borrowed monies rather than the security that you provide. And that is very, very important. For example, if the borrowed monies are used to purchase an investment property, whether it be commercial or residential, then the interest and charges for that loan are generally tax deductible. Obviously, on the opposite side, if the funds are used for private purposes, then the interest is non-tax deductible. Let's have a look at a couple of examples, because this is a common thing that we see, especially with new clients that come to us where maybe they were unaware of these type of things. So as an example, a taxpayer owns his current home, and he may even own it outright because they've owned it for a few years. Like I said, perhaps the family, they bought it when they first got together or married, and now the children have come along and they need to upgrade. They decide to build a new home to live in with the family and rent out the old one. They take out basically a new loan to build the new home, but using this old property as security. The money borrowed to build the new home is private. Even though they use the security of the property that's going to become the investment property, the purpose of the borrowed funds is to build their new home. Therefore, the interest is non-deductible. Be very, very careful of that. Yes, there's other things that we can look at and do as accountants, but very important. So the fact that the interest paid on the money borrowed, and as another example, some people redraw on their home loan or on their investment loan, I should say, and they use that for private purposes. For example, to buy a motor vehicle or a jet ski or go on that European vacation. Well, you probably won't be able to do that for a little while at the moment. But that money, or the purpose of that money, is not for your investment property. It's for a private purpose. So you need to be careful of that, and we need to make the appropriate calculations and schedules behind the scenes, just in case the ATO asks questions. Is an investment property held in joint names? Then the interest should be split jointly according to the legal ownership of the property. Some other common errors: interest paid in advance can be used as a fantastic tax deduction. So that's something to consider. Okay, so very important. Mortgage offset facilities are available. How does a mortgage offset facility work? Generally, if we have a loan, say for 200,000, but we have cash sitting in the bank for 100, you would park that in an offset facility, and the two would be netted off, and you'll only pay interest on the balance. However, you have the flexibility to use that redraw or that mortgage offset facility in the future. We'll have a look about how we can keep the banks honest in a moment, and be very careful. And most people get confused with this. It's not the repayments that are tax deductible on your tax return. It's the interest portion only. So a lot of people get confused with that. And that's why we commonly ask for copies of loan statements to work out the difference between the two. So that's a little bit about interest. A lot of people get tripped up in this area. Another common problem that we see is repairs and maintenance. People think no matter what they do, they can claim a tax deduction for it. Generally, as a landlord, there's always going to be two types of repairs that you will incur. The first one, initial repairs at the time of purchase, or repairs because of tenant damage. Let's have a little bit of a look at each one in a bit more detail. With the first one, any expenditure incurred on initial repairs, generally, and that could be repairing holes in a wall, it could be giving it a fresh coat of paint, there might be some capital expenditure. Generally, that will not be tax deductible because we cannot argue it's as a result of tenant damage. There may be things, for example, if you were to put a brand new split system air conditioner on the wall, then we could look at depreciation for that. But generally, you cannot claim them as a tax deduction because they do not relate to to tenant damage. Whereas on the other hand, repairs because of tenant damage. So generally, this would be regarded as repairs versus improvements, but you need to be careful of that classification. What would a repair be? It's generally restoring an item to its original condition. Examples would include, like I said, fixing a hole in the wall, perhaps repairing some broken windows, or fixing up the plumbing or some electrical appliances. Generally, they would be regarded as repairs. They are restoring something to its original condition. Improvements, on the other hand, are generally not tax deductible. What's an improvement? It would be classified as an alteration, an addition, or an improvement to the property. An example would be building a carport, or perhaps, like I said, the installation of a brand new air conditioning system. These, though, and other items could be depreciated over a number of years. But that is, again, an area where a lot of people presume that they spend money on a property, then they can claim it as a deduction. We need to have a look at the character and the reason behind it. Depreciation, very, very important. Depreciation is basically writing off the capital cost of an item over its estimated life. And basically the cost of an item would also include installation fees. So again, with the air conditioner of a split system, if you bought it for $2,000, then it cost you $500 for someone to put it on the wall and hook it all up into working order, then the total cost is $2,500, obviously. Again, there's two types of depreciation available, and generally that's improvements and structural items. So with improvements, they're generally allowable in a tax deduction where the expenditure has a greater life, or the asset has a greater life of 12 months. So that would be an air conditioner on a wall, or perhaps building a bit of a decking area, as long as it's not adding too much to the property. Structural items are generally those things that cannot be removed from the building without causing significant change or damage to the building. And that might be built-in wardrobes, installation in the wall, plumbing, electrical wiring. Also things like kitchens, bathroom units, possible doors, etc. Those are structural items, and generally we can claim depreciation on them at 2.5% per annum. Okay, so very important that we can do all these type of things. So how does the structural side of things work? So like I said, a taxpayer can generally claim the cost of expenditure incurred on the rental property. The deduction is available anywhere after the 17th of July 1985, and it's generally 2.5% per annum. However, we as accountants or your local real estate agent or a solicitor cannot determine or calculate this number. You need to get a quantity surveyor involved to give you a full-blown report, and then we can use that from year after year. But it's certainly something that we encourage all our clients to do with every single property they have, because generally the cost of getting a report done, also tax deductible, will certainly be a lot less than the benefits that you will receive. The one important thing though is where we claim depreciation under this legislation, it will reduce the cost base of the property when we dispose of it, resulting in a higher profit. So it's a timing entry rather than a total tax deferment. Quickly on insurances. So generally speaking, for your investment property, insurance premiums are tax deductible. Be very, very careful. Sometimes we see clients that have an insurance policy and they've owned the property for 20 or 30 years, but the policy has never been updated. Have a look at your premiums or your policy notices and see how much you're covered for. The last thing you want to do is have a policy that only has $158,000 worth of replacement. You probably won't even be able to build half the house for that if it burnt down, for example. So check your insurance policies, not just with investments, but even the home that you live in. Very, very important. Before we move on, I just wanted to quickly touch on, like I said, the ATO recently and our governments have spent a hell of a lot of money. And as you're aware, especially because of COVID-19, we're in a lot of debt, and the generations to come will be repaying that for many, many years. More importantly though, make sure you have the documentation in place and stored away. Please seek the advice of an accountant to help you, especially around some of the things that we spoke about, like interest and repairs versus improvements. They are watching. State Revenue Office, for example, and the ATO talk and diverge information. So just because you didn't get caught last year doesn't mean that they won't ask questions next year. Be very, very careful. Many of our more successful property investors out there also commonly take out tax audit insurance just to protect themselves. Now, banks, let's have a look at the banks. So the banks at the moment are very, very, very hungry for the right client. They're bending over backwards during this situation we find ourselves in. As you can see, hopefully that's not too small to read, but we have some of the banks and the different interest rates that they're now offering on a variable loan. Quite attractive. And this is the retail rates. Generally, when we're talking to these different banks, they will offer us and even cut these rates further. So what do I recommend here? Like I said, the banks are hungry for the right client. If your loan does not start with a 2 at the front of it, speak to us. You are paying unnecessary money to the bank when you do not need to. With Lucy, our loan broker that works inside of our office with all our clients, we regularly review our clients' loans, and we will tell them if we believe they can get a better deal. And if you've got any questions, I'm more than happy. That's how you can contact Lucy. Lucy will be able to assist, but the objective of all this, go shopping to save money. You would always prefer to have a lower interest rate where you can basically pay more off the principal versus interest. Buying property or any investment for that matter is all about building your wealth. So you need to look after your own loans and you need to be sure that you have the best possible deal. If you're not reviewing them annually, you're probably not on the best deal right now. I promised you at the beginning of the webinar, I'm wary of time here, so I've only got a few more slides to go. But I promised you at the beginning of the webinar that you'll be able to watch and listen this again. You can download all the slides, and if we also have any PDFs, we'll attach them as well. So you can log on to our website. We have a section there under resources, which has or houses all our webinars. There's the last couple that we've done. So for any of you in Victoria that would like more information on JobKeeper version 2, especially in Victoria, you can basically download and watch the webinar. And we also a few weeks ago had a webinar on the federal budget and all the updates that were promised there. This is where we will load this webinar as well. Give us some time to do that, but hopefully it should be up there by later on this afternoon or this evening. Again, with our website, there are many, many resources there. Fact sheets, tax checklists. We have occupation guides. So if you're a nurse or a fireman or a teacher, you can download a guide to tell you what you can claim as a tax deduction. So please jump on our website. There's the location. Feel free, go for your life. If you have any questions or anything you want to clarify, you can contact us directly through the website or feel free to yell out as we mentioned. So obviously, we've mentioned a lot of initially here about how we buy a property, what types of property, some general tax deductions available. But more importantly, the second part of this series or this webinar will come up in a few weeks. So if you haven't registered, please do so. For those of you that already have, we'll certainly thank you in that regard. We'll pop the link on the, we'll send you a follow-up after this webinar and we'll pop the link on that one for you. But what are we going to look at? Structuring, very, very important. SMSFs and how do we buy property through it? How do we look at a cash flow analysis when we're buying a property to make sure we understand the ins and outs of it all? What are we looking at for property next year and beyond? What are my thoughts and what are the experts thinking around property? We have the Reserve Bank meeting on Tuesday where they'll consider dropping interest rates further, which there is, depending upon which expert you listen to, there's talk that they could drop even further. Why does the Reserve Bank decide to drop interest rates? It's a strategy to stimulate people borrowing more and spending more in our economy. And certainly at the moment, that's what the government want us all to do, is to spend money to help the economy thrive and recover with what we've gone through. And then we'll have a look at some next steps when you're buying property and what I would recommend to do in that regard. So let's, before we get stuck into this, actually, no. So when we, what's your focus all about, guys? Well, our focus as your accountant or as your tax agent, it's basically to educate you with what you can do versus what you shouldn't do through webinars, newsletters, marketing materials that we produce, etc. Your focus should be all about investing in yourself, building your knowledge, read books, speak to the right people, attend seminars and webinars like this. So it's fantastic that you've taken an hour out of your day to do that. Jump onto our website. Again, invest in yourself with all those brochures. It certainly doesn't hurt in that regard. Before I conclude, I'm just going to jump in and see if I can see some of these questions and see if I can handle it. Joe, I think it is, do you suggest to purchase investments in a family trust? What if the principal place of residence, but you want to protect it and pass down generationally? Certainly, Joe, some people do purchase properties in a family trust. This is where in our next webinar, we will touch on structuring. We at Chan & Naylor also have a product called a property investment trust, which we have a separate ruling upon. So I'll touch on that a little bit more at the next webinar, or feel free to reach out, because it totally depends upon your particular situations and what your goals and objectives are that you're trying to achieve. Pratt Tap, hi Peter, if we do a subdivision of our PPR, then in which structure is good? Can we do a new title in the trust? So thank you, Pratt Tap, I hope I pronounced that right. But quite simply, there is an opportunity if you're doing a subdivision that we should certainly look at different structuring. There are costs, but there's also benefits in doing that. And it's probably a matter of us having a consultation to understand more, and then we can advise you accordingly. I think it's Joshy. Can we use the money in an offset account linked to your investment property for shares or other investments and deduct the interest for tax purposes? Generally speaking, if it's sitting in an offset facility, it's cash in the bank. So if you're going to use that cash in the bank to then go and buy other investments, you're not actually borrowing money. But what it will do is increase the interest that you're paying on your existing debt. So generally speaking, that interest will become deductible. But if you're going to be paying cash for money that you currently have sitting in an offset facility, then generally speaking, it's not going to be tax deductible. What else we've got? Sarah, can we please have a link to register for the second webinar? So yes, certainly we'll provide that to you, no problems. Can you touch on flats versus independent buildings? I'm not sure what you mean by independent buildings, but Errol, if it's something you want further info on, I'm more than happy to have a chat to you. Just get in touch. Is child support affected by negative gearing? The short answer to that is yes. Negative gearing is a fantastic tax strategy, but Centrelink treat it differently when they're looking at things like child support, family tax benefits, etc. So again, I'm more than happy to have a chat to you in that regard. Apart from that, guys, that's about it. I promised you I'd finish within the hour, and we're right on target. So what should we do next? Well, like I said, please register for the upcoming webinar. We'll have those links on the thank you that we send out later today. Talk to us for assistance. When you're looking at investing, like I said, a hell of a lot of money, it's worth having a chat with the professionals. Please speak. For the money that you're going to be spending and the decision that you're going to be making, it's well worth, obviously the benefit will far outweigh the costs. Make sure all your compliance is up to date. So tax returns, BASs, super for those bosses out there. Why? Because if you go to borrow money or deal with banks, generally they'll want to see your latest tax returns. They frown upon when they see debt owed to the ATO. So very important in that regard. Like I said, we'll certainly follow up with today's recording and slides via our website. And the biggest question, what do you need to do to get financially sorted? It's in your interest to do that. No one is going to knock on your door and just give you money or tell you what to do. You need to get educated, you need to build a network around you, and you need to ensure that you take the initiative and get yourself sorted. My contact details are listed here. Feel free to reach out. Otherwise, thank you very much, guys, for coming along today. I appreciate you taking an hour out of your day, and I look forward to speaking to you again all in a couple of weeks with the next webinar, and feel free to reach out if we can help. But otherwise, thank you very much. Cheers. Bye-bye.